Hey, good morning, traders and investors, and welcome back to our weekly live stream show. I'm your host, Bennett Tyndall with TradingAnalysis.com. We appreciate you all taking time out of your Wednesday mornings to join us. Happy Wednesday, May 18th. Markets continue to remain volatile this year. As you can see, bottom left-hand corner of your screen, S&P futures are currently moving lower. We had a few interesting earnings reports out this week. Target reported this morning, as you can see, bottom left-hand corner of your screen, fading a 225 handle bid yesterday into a low of 161 this morning in the pre-market. We haven't had a chance to take a look at that report, but clearly not a favorable response from investors. Overall, the volatility continues in a manner that is to be expected. We went into April essentially suggesting April would confirm the uptrend resumption or fall victim into our alternate wave counts. And now that we are seeing markets attempt to defend an equality projection of the initial decline being the January highs in through the February lows projected from the late March high. Now that we've seen markets attempt to defend that equality projection, we have to ask ourselves whether or not this is the end of a three-wave retracement or if in fact there is a larger downside move upon us. Before we get to the charts, we'll go ahead and bring in the trading analysis team. Good morning, Terry, and good morning, Alex. How are you all today?
Morning, Bennett. Good afternoon, Alex.
That's right.
Hello, everybody else.
Afternoon in Serbia.
Thank you, guys. Good morning to America.
That's right. That's right. It's still before 8 a.m. here in Texas for Terry and I.
Yeah, but man, it's a hot. Bennett, you're gonna get up to 95. I saw that today, and
yep.
Man, it's just all across Texas. We've already got 100+ degree weather out in West Texas, and
it's been quite the year. Man. Yeah, it's been quite the year in terms of weather events. Even going into the winter and now into the summer, expecting a potential drought. It's going to be an interesting
already
year.
You're in a drought. You know, that's a bad thing. Of course, you come from California. You know all about those droughts and wildfires and stuff like that.
Yeah, it was pretty much par for the course over there.
I thought I saw a news clip a few days ago that showed they had some early, didn't they? The coastal fire was at Laguna Beach, burn up 20 or 30 homes or something like that.
I did see that. Yeah, I think it was like 75 potentially, or there were 75 in the neighborhood.
Wind. That wasn't even the what do you call it? The Santa Ana winds. Yeah, that was a different.
Yep. So it's going to be interesting. It's going to be interesting. I miss the scenery in California, but I don't miss other things about it. So we'll leave it at that. Anyways, hey, anything before we get into the open here? Markets, we've got about 34 minutes until the bell. As you can see, S&P futures did fade the just shy of a 4,100 handle bid that we had yesterday. We're currently trading 40.42. We actually put a speculative kind of follow-up short position to work yesterday, looking at that move back as likely counter trend. There was obviously the possibility that the C wave low was upon us, and we were seeing upside resumption, but we don't quite think it's here just yet. Alex, any comments with the Fed beginning QT in June? Any thoughts on the outlook in the markets, equity markets?
Well, I mean, depends from which perspective we are looking. If we look from the technical perspective on the higher time frames, we still don't see a clear 5 waves down, which will actually exercise the biggest or the most sizable pullback, just the 3 waves down. So in my opinion, I mean, the cards are still not revealed. It can be a move up in X and then we move another leg down in Y, or we go in triangulation and we do move up. So from the fundamental side, Fed is obviously, after the Jerome Powell yesterday talk, will be hawkish on rates. Energy prices are still moving on the upside, so geopolitical situation is still tense. So I don't see for now. Maybe we're going to see a little bit of an ease off in rates and commodities in the next couple of months after the next Fed meeting. So I do see that on the charts, but overall, the team is still pretty much very hawkish on rates. As you know, we cannot evaluate in this moment how much of that market is priced in. So I will stay neutral, still observing with a couple of scenarios, but we are kind of in the middle, in my opinion.
Very good. Yeah, we're most certainly in uncharted territory or waters, if you would. Speaking of energy, Terry and myself have been watching a consolidation for both WTI crude oil as well as the energy sector, looking at a possible entry opportunity there on the long side. All right, I'm going to take you all through the indexes. We'll take a look at the S&P, the NASDAQ. We will also touch base in the Russell 2000. We'll take a peek at the SMH, Semiconductor ETF. Anything else specific, gentlemen, that you would like me to cover while I am in mode of wave? We're good?
Staple sector. I want to see that. I want to see the staple sector.
Absolutely. Absolutely.
You and I didn't get a chance to go through all the sectors yesterday. So, but that was one I wanted to take an extra look at.
All right. Sounds good. I'm going to take you through the charts. We'll be back on the other side, carry on into sector focus, and then we'll wrap up with macro. Catch you guys in just a couple of minutes. All right, good morning. Once again, we do appreciate you all tuning in. Let's hit it. Hard right edge of the Motive Wave platform. We're going to go full screen on the charts here. And as you can see, we're looking at price action in the S&P 500. Looking at price action in the S&P 500, we are on the daily chart going back to the high from January 4th. It's in January that we see either a wave 3 or more likely a wave 1 of a higher degree wave 5 ending diagonal coming to completion. That puts the current correction in a wave 4 or wave 2 position, more likely a wave 2 position, which would support a more significant retracement of the rally that we've seen from the COVID low. But looking at the chart, we've seen not as much clarity as you would expect. If you were to truly expect this to be simply a garden variety pullback, the clarity, although offered with symmetry of corrective legs and the adherence to guidelines, is offered in the S&P. It's offered also in the semiconductor ETF. But there are many charts which are showing more decisive 5-wave rejections. And one of those charts includes the chart of the NASDAQ 100. We reviewed last week the fact that the secondary decline in the NASDAQ was actually a more significant angle of descent, which is not typical of a corrective trend. But looking at the S&P last week on the 11th, we discussed the possibility that we were actually approaching downside support that could offer a motive impulsive or at the very least a corrective bounce. So going back to January, we have a clear 5-wave trend finishing into the February 24th low, a 3-wave retracement, which took us into about a 78.6% retracement of the January 4th through February 24th decline. And from there, if we take a look at an equality projection, meaning we measure the magnitude of that decline, we project that from the B-wave high, we arrive at a downside equality projection at around 39.33. And as we met that zone, we were also meeting the standard corrective trend channel that is sourced from the January 4th high, drawn through the late March high with your parallel trend line over the February low. So as we met the low of the 12th, we talked on the 11th about the possibility that we were coming into a possible ABC completion. As we met that downside fib support, we also had corrective trend channel support, and we could also see a clear 5-wave decline. Now, given this 5-wave decline is a bit subjective in that there are a few subdivisions that don't quite meet the guidelines, such as the right look, there is enough evidence here to suggest that that was possibly all of the move. Now, given the fact that we've been in a season of uncertainties, we felt it would be more appropriate to let the markets confirm this view. And this still remains a valid possibility. If we can see continuation from the May 12th low and move above this downside corrective trend line, and then continue to exceed key retracement levels while forming a motive trend, be it motive impulsive or motive diagonal, a 5-wave rally met with a 3-wave retracement would offer a fairly low-risk entry in the indexes on the long side. If you can see 5 up and 3 waves back, stops would be offered at the lows. initial take profit target at the previous all-time high. And of course, as we look at this chart, we can't help but consider the alternate possibility. And the alternate possibility would suggest that the bounce that we see here is simply a technical move, and we are going to see the more significant 1618 fib projection of the A-wave decline. There are a few different factors, that go into our decision-making process as we meet those lows. Generally speaking, when we go into a major market reversal point, you will typically see extremes on the market internals, such as we saw into the December 2018 low, or as we saw into the March 2020 COVID low. We have yet to see those extremes be expressed in the market internals. We've also yet to see bullish divergence into the price lows. Technically speaking, the daily RSI low into the 12th was above that of the 24th, but you don't have clear divergence, nor do you have divergence on the MACD. So a lot of factors that all go into this decision making, and at this point, it's essentially a wait and see game. We have evidence to suggest ABC is in, but there is also a case to be made for continuation to the 1618. So depending on how today's market session unfolds, we could have the evidence to suggest continuation down to the 1618 near 3591. So that's the S&P 500. Over to the NASDAQ 100, as mentioned at the beginning of the update, while we have a similar zone of support that was offered into the 12th of May, we have a descent here in Wave C that is really best described just based on the characteristics of the trend as part of a higher degree impulse wave. And in this instance, if this is just a garden variety ABC pullback and correction in the markets, the significant angle of descent that's expressed in the C wave compared to the A wave is a bit concerning. It doesn't mean it's wrong and then it can't ultimately confirm corrective completion with 5 up and 3 back, but for the time being, we have to remain cautious. So here in the NASDAQ, we did get a bounce up just from equality. If we can exceed a short-term downtrend resistance line, which is simply sourced from the Wave 2 high through the Wave 4 high, a move above this trend line combined with a motive trend and a break above key retracements would at least start to suggest that there's the possibility the ABC correction is over. But I don't think that's the case. I do think markets press lower, which is why I personally took the opportunity yesterday to put a short position to work in the S&P. 4-to-1 reward risk ratio, highly speculative given the fact that there could be corrective completion upon us, but well-defined risk. So that's the NASDAQ and the S&P. You've seen the 1618 target, it's south of 10.5. Over to the Russell 2000. Here in the Russell 2000, we technically have a standard, at least in terms of the structure, a standard 535 Elliott Wave zigzag. Here in the Russell 2000, we came just shy of our equality measurement at 1647, but we technically have 5 waves in A, 3 waves in B, and another 5-wave decline in C. But similar to that of the NASDAQ 100, the angle of descent that's expressed here unfolded just beyond 38% of time elapsed in the A wave, meaning we met the magnitude of the A wave in only 38% of its duration. That is a bit of a concern and something I will be watching into the coming sessions. Now, if we take a look at the semiconductor industry group, a very key industry group within the technology sector, here we actually have a more appropriate and more traditional ABC zigzag that does follow many of the Elliott Wave guidelines. This would suggest a 5-wave decline into January, was met with a 3-wave flat into late March. In fact, initially, I had my B wave anchored into the February 10th high, looking at the possibility of the March 14th low as the C wave, identified and advised late March resistance that should either confirm that view or dismiss it. But even with the break under the March 14th low, there's not evidence here to say that this is a motive trend. This still appears to be a garden variety 3-wave correction. And in fact, you have the typical guideline expressed in regards to the angle of descent in the C wave compared to the A wave. 5 down of A, 3 of B to make an overall B wave flat, another 5-wave decline into the May 12th low. Looking at the C wave, we met price equality at about a 161% time projection of the A wave, meaning time elapsed in C was about 161% of time elapsed in A. This is more traditional and typical, if you would, of an ABC zigzag. Doesn't mean that this is not a mode of decline, and we will, of course, be watching the signs off of the low to determine if we're headed to the 1618 in the S&P and the NASDAQ, or if there's the possibility we attempt to defend the May 12th low and continue higher. All right, just looking through the questions here. You know, who is that? Let's see. Sorry, my text is so small here. It looks like Mr. In regards to the NASDAQ 100's C wave subdivision, you bring up an interesting point, but there is an argument to be made for the completion of this trend. Here's the issue. If you take this down to a 1-hour chart and you break down the subdivision possibilities, what you're met with is a third wave that just exceeds equality to wave 1, a fourth wave that is essentially appropriate in terms of time elapsed to wave 2, and then we have a fifth wave that takes us just beyond a 61% relationship compared to 1 and 3. That's fairly typical when your wave 3 is just beyond equal to 1. But to your point, the C wave decline in the NASDAQ is a bit subjective, and it does offer alternates that would allow for further downside. But if we break downside channel support and downside fib support at our equality projections, I think the next highest conviction target would be the 1618 retracement. So it's going to be an interesting market. It's been a very challenging market here in 2022. Looking forward to where it takes us. So that's it for me this morning. Let's get back to the trading analysis team. What do you guys think?
My XLP.
Oh, hey, I'm on it, Terry. I got so wrapped up in the indexes. I'll be right back. Hold that thought. All right, here we go. We're going back. We're going back to the charts. Let's hit consumer staples because it's a great topic. It's a good discussion, and it's quite the interesting chart. So first, I'm going to show you the view that would suggest the possibility that we completed a cycle degree wave 5 dating back to, in this case, the 2003 low. And the indexes were sourcing uptrend resumption from the credit crisis low. Here in the consumer staples sector, there is an argument to be made that from 2003 in through 2008, you actually have a motive trend, and then you have a 3-wave pullback to the 786. So from the credit crisis low, we can count a smaller 5-wave move, and I'm going to hide this and bring it in 1 degree at a time. We can count a smaller 5-wave move to make up cycle degree wave 3, pairing up to cycle wave 1, and in this instance, cycled wave 3 met about a 200% 3-in-1 relationship. We then move lower in a 4th wave correction that exhibits alternation to its wave 2 counterpart. And as you all know, in a wave 5, when you exceed a 1272 external retracement of the wave 4 decline, and you have a 3rd wave that is extended, you start to look for equality of wave 5 compared to 1. Equality of cycle degree wave 5 compared to wave 1 for the consumer staples sector came in at $81.01. In addition to the 5v1 equality projection, we also have a very common Elliott Wave channeling technique, which takes the low of wave 2, establishes a trend line there through the low of wave 4 and your parallel trend line over the top of wave 3. When you use the 243, as we refer to it, trend channel in combination with upside fib projections, you can often substantiate a major 5th wave top and look for signs of exhaustion. Now we have to ask ourselves, zooming in on this trend, do we really have 5 waves up from the COVID low for the consumer staples sector? And getting off of the weekly, we're going to focus in on just that very question. The wave count in the consumer staples sector is a bit unique. You may look at this and think, goodness, this doesn't meet any of the typical guidelines of an impulse wave. You have a third wave of the primary degree that's extended, but inside of it, you have an intermediate fifth wave that's extended. As long as your third wave is not the shortest, there is no harm or reason to shy away from an interpretation that would be viewed as you see here. This would suggest from the COVID low, we have 5 up in 1, a pullback in wave 2, smaller 1, 2, smaller 3, 4, all the way up to blue 5, which completes potentially primary degree wave 3. In this instance, primary degree wave 3 exceeded equality to 1, but wasn't quite a 1618. But then, based on the guideline of equality in regards to our corrective legs, our fourth wave paired up beautifully to our wave 2 counterpart. And from there, gets even more interesting. Allow me to clear my ratios and adjust scale before continuing the discussion. The same trend channeling technique that I just showed you on the weekly for the cycle degree applies to the smaller degree of trend. In this instance, the primary between 2, 4, and 3 of the orange degree. That zone, as you can see here zooming in, is exactly where the consumer staples sector met resistance. So we had cycle degree 5 and 1 equality, we had primary degree channel resistance, and now we take it a step further. We do the same exercise off of the daily and down to the 195. Is there a completed 5-wave trend from March 11th in through the recent April 21st high? There's an argument to be made that that is in fact the case. We have a third wave that's appropriate, a fourth wave that pairs up, and the guideline of 5 and 1 equality is expressed in the blue intermediate degree as well. What's even more interesting about this is as follows. When we discussed our 5 and 1 target of the cycle degree up at 81 and change, we had to at least be aware of the possibility that this move up was only wave 1 of primary wave 5. But if that was only 1 of primary 5, then we would have expected to see a corrective trend. But we did not stop at a 3-wave decline. We instead printed 5 waves to the downside. So we now have a 5-wave decline in the consumer staples sector, down in 1, up in 2, down in 3, over in 4. 5 is completing and giving way to some sort of a corrective retracement. So that is a concern. If this 5-wave decline, and I'll draw a quick retracement of this rally, we're bouncing off a 618. So could this potentially be some sort of a complex move that appears motive? It's possible that this is ABCW, X, ABCY, but it's unlikely unless we start to see evidence to support that view. But if we now see this directional 5-wave trend be met with a corrective sideways move, you may be getting an entry for a short opportunity back to the previous 4th wave low. So that is a concern, and that's something I'm watching for consumer staples. Sorry about that, Terry. I got...
No, perfect. Thank you. That is very interesting because I wasn't actually looking for the 5th wave of the cycle degree to have been completed in April. So that's, you know, so the only thing is I hear those guidelines with the 3rd wave extended 5v1. That's the highest likelihood, but I don't think it's written in stone. Would that be true? Can't hear you, Bennett. Lost your audio.
Not at all. Not at all written in stone in regards to 5 and 1 equality. It is a guideline. It's kind of a series of exhausting fib targets, as you know, and then that's why we get off the daily and down to the smaller time frames to really analyze the subdivision and what the hard right edge is telling us.
Your analysis tells us we need to be cautiously optimistic that we're going to see staples continue in an uptrend, but we need to be looking for those signals that may be coming around the corner that a major rotation again is about to happen. So
yeah, if this 5-wave move down does hold with 3 back and we get another 5-wave move, that could just be the ABC of wave 2, such as I see here on your chart, and that's certainly a possibility we should continue to watch for. So all right, excellent work. Let's carry on into sector focus. You ready to rock, Terry?
Yep.
All right, take it away, and we'll be back on the other side. 12 minutes to market open.
Hello, traders. I'm Terry Long at tradinganalysis.com here with your weekly sector focus. So it's been 6 weeks in a row now that the indexes have ended the week to the downside. Hang on a second. Let me get that out of the way. My apologies. That little data box gets just a little bit too much information. Okay, let's continue. 6 weeks in a row down. That's something you don't see very often in the markets. 5 weeks, maybe 6 weeks. We're getting pretty extended. So, when Bennett talked about this whole move as being corrective, this part of the move is not corrective. This is the C wave. The C waves are motive or impulsive. The correction is A, B, C. That A, B, C, that whole move there is the corrective move. So, Bennett, I'm okay with seeing this sharp angle of descent there, but it would be nice if it was a little bit further laid out. Anyway, 6 weeks in a row down for the S&P, 6 weeks in a row down for the NDX. It's no wonder that we're getting a pretty strong bounce here. But the low for last week was actually seen here on Thursday, with both the S&P and the NDX starting to close higher on Thursday. So 1, 2, 3, 4. So now we've got 4 days in a row. It's funny, the market pundits are already calling this a rally. I'm like, yesterday when they were talking, it was only 3 days, right? So there were 3 days, we're in a rally. I'm like, when's the rally going to stop? I'm like, guys, come on. We're just trying to get out of the corrective, the overall larger correction here. So watch what you hear there. 10 of the 11 sectors last week closed in the red. Consumer staples, that's one of the reasons I was asking Bennett for that analysis, being the only sector last week that showed just a slight positive gain of 0.3%. Now, although they ended lower on the week, the communications, healthcare, and utility sectors were seen outperforming the benchmark S&P. That's this purple one here is the S&P. So anything to the left here, they were down on the week, but they technically outperformed. And those things here with larger declines, they underperformed the S&P here. There were more than 3% losses on the week in technology, financials, and consumer discretionary and real estate sector. Real estate sector is really coming off strong. All right, let's fast forward to this week and take a look. You can see here energy once again making a move higher. For the week so far, we are up 1.61% here in the S&P, 1.43% in the NDX. Now, Monday's trading, you're going to look at this little Doji Star, Morning Star, whatever you want to call it. Monday's trading was very quiet, actually. It was positive, but it was very uneventful. Tuesday is where the action really started. Saw the indexes push successively higher and actually closed back above last week's high. The NDX finished up 2.62%. The S&P was up about 2%. Now, semiconductors took center stage with the SMH rising 4.78% yesterday. So Bennett showed a chart of the SMH, and in that correction, if my mic had been active, I would have jumped in there and said something about, Bennett, look at the size, the magnitude of that move off the bottom in the SMH compared to the corrective move down. That's one of the larger moves, I believe, of any of them. And of course, the SMH is a major component of the NASDAQ, so it's going to help it out. Now, AMD got an upgrade, and shares of AMD rallied 8.73%. I know we've got a bullish tilt on AMD, Bennett, so would like to hear some more about that. Sector performance for these past 2 days really has been the energy trade, materials, healthcare, and industrial sectors. Let's pull this little table over here. You can see the live numbers now. Energy up 4.43% on the week. Materials up 1.89, industrials 1.4, right? So, and healthcare actually 1.3. But to the downside, it is the real estate sector, not down huge, but still in the red. Staples is down, and consumer discretionary is down. Over here in our relative strength sector leader scoreboard, the energy sector remains here in the highest relative strength, but you've seen this sharp hook reversal that occurred to the right, and then now it's sharply snapping back to the left. Once again, we've resumed a declining momentum heading. Now, today I'm seeing crude oil prices rise to like 114. There's some more talk about with the China lockdown possibly easing, that the China energy demand will start to rise again. But at the moment, there's a lot of Chinese energy that came off of the markets. It's amazing to me that the energy actually held above 100 during that whole event. But energy is now pointed to the southwest. Let's zoom in a little bit over here and look at our leaders. The utilities, staples, healthcare, materials, real estate, and industrial sectors, they continue to remain in the leading quadrant. But we are now seeing southerly hooks and declining momentum headings here in the utilities, in the materials, definitely in the real estate. And the real estate actually has the most pronounced hook reversal, and its vectors already turned yellow too. Now, this is possibly setting up to follow that financial sector down here into the lagging quadrant. That'll be interesting. Industrials is kind of a downtrend there, and really it's the materials sector and the staples sector that continue to push higher into the leading quadrant. So that'll be the next thing. That's why eyes on the staples sector for overtaking utilities here soon, maybe in the next several weeks. If this vector continues to improve and this vector continues to fade, we could see the next highest sector staples. Now, it's also possible that we immediately get that hook reversal if we're really going to enter the major corrective move in staples, that this may play out and die and then fade, and then that'll be the beginning of a new larger rotation in play. Now, financial sector and technology and consumer discretionary are down here in the lagging quadrant, but we did see this major hook reversal here in the financials. The big boys a lot. Let's jump over real quick and just take a look here at this is the XLF relative rotation. There's not a lot of blue in here yet, but I did want to make note that a couple of weeks ago, we started seeing these vectors starting to hook back to the north. That means collectively, you're starting to reestablish momentum here in the financial stocks. And also consumer discretionary kind of meandering out here, still kind of wandering, not really too interesting. Now, over to the communications sector. The communications sector did technically outperform the S&P last week, but it only had a 0.61% decline, and it has begun to form a northeasterly heading, though it is still deep in the improving quadrant for now, and with the lowest relative strength of all the sectors. Paramount, with Paramount Plus streaming service, jumped 15% yesterday as news that Warren Buffett was accumulating a significant position in the streaming service. Now, could this be the catalyst that finally launches the XLC back towards a leading condition? That's all I have for you today. Back to you, Bennett.
Very good. Much appreciated, as always, Terry. And that poor communications sector has just been back and forth, back and forth. Not quite sure what it wants to do as it juggles between lagging and improving. Quite the interesting developments. All right. Oleg, I see your question. I apologize for missing that when I was presenting charts. Do me a favor. Send me an email, Bennett, BENNETT @tradinganalysis.com. 2 N's, 2 E's, 2 T's. And I'd be happy to follow up on that with you, because I do like the idea and possibility there. All right, Alex,
give Alex the screen here.
Something tells me Terry's going to beat me. He did.
Yes,
he did. I love it. Alex, sir, let me know when you are ready to rock. S&P futures 4037. We've got about 2 minutes till the open.
Ready to rock. Let's roll.
All right. We're going to touch base on the macro scene. We'll be back on the other side to wrap up.
Hey guys and viewers. So let's dive into a macro picture. So currently, uh, the next kind of a, let's say, a view of the market, how the Fed is going to progress on rates is pretty high, following the yesterday Jerome Powell talk. 50 basis points for the next rate hike, which comes around 15th of June. It's already at 87%. And as you can see, I don't think they're gonna jump to 75 basis points. It's only 30%, but who knows? Things can change. Obviously, as we are going to see, the commodities are still moving sharply on the upside on many fronts. So we cannot expect the inflation to move a little bit and budge lower in the next couple of weeks if we see commodity prices still moving on the upside. So the overall themes are still yields moving further on the upside. This is the 10-year yields. We are tracking the wave count, where we are going to have a little bit of more on the upside trajectory in the next couple of weeks. So we do see a 5-wave move forming. Potentially this is a 5th wave. This is the longer term chart. So if we look from the higher perspective, we will notice that this previous consolidation is most likely a range over resistance technically. Also the RSI is relatively pretty high. We are backing down a little bit, although I still don't think this is the end of this move on the upside. Probably in June on the next meeting, this will be the last move on the upside before we have a slight pause in the commodity spectrum and in rates. So I do see in the possibly next half or next 2 quarters inflation to go a little bit lower due to these technical patterns that we see on rates and commodities. So we do expect short term this to continue further on the upside before this pause, which might, as I said, be in the next half of 2022. If we look German 10-year Bund, so this is the yields, we still don't have a 5-wave move actually formed. We need to have this technically to actually start to look for some type of an ABC, which will tell us that this is impulsive, full impulsive development on the upside. We are trading at 1.07%. Just to remind you, just a couple of relatively COVID crisis low, I will say we were trading around minus 0, almost 90, so close to -1. So these developments has been obviously bullish, but we cannot become further bullish until we see a clear 5-wave move. And the ECB has sent some signals that in July meetings they can change their monetary policy. Of course, the European situation from the geopolitical standpoint is very tough, and US it's in much better ground with lots of independence with gas, oil, commodities production than currently what is going on in Europe. So I think ECB has a smaller maneuverability in regards of rates, and I think we will see rates on the upside, but in a very modest manner. If we switch to commodities, first let's look at dollar index. Of course, if we see the developments on the new high, we posted around close to 105. We are backing off a little bit, but this is still just a corrective pullback. We do see also the high readings on the RSI, but I don't think this wave structure is complete. We will look for a smaller consolidation and then a further move on the upside. Extreme levels in dollar can go to 111, 112, but this will be just an extreme one. I will be a little bit more modest in the current situation. I will go for the little bit of lower levels around 107, 108. and then we will see what the dollar index is going to do. Are we going to finish this cycle? We're going to have some type of retracement, or this fifth wave will be a vicious move higher towards this couple of Fibonacci levels, which are nicely clustering between 112 and 113, which will be a pretty sizable move from 103 currently, and which definitely will not paint a good picture for the emerging markets and everybody who has loans, credits, and obligations in US dollars. If we look at the CRB commodity index, so still we are moving on the upside. I do think that we are close to the end of this cycle, which we see also on the rates. If we overlay, and I showed that many times, US 10-year, which is also a natural, I think, phenomena. Not ideal correlation in the past, but from the COVID crisis, as you can see, we are moving pretty much in synchronicity towards upside levels. So the commodities and rates kind of following each other. As we see the fifth wave in rates, we see that also in this CRB index. We do see this as one of the last consolidations in this fifth wave. So as in rates, a little bit more upside, and then a couple of months pause before potentially we continue further. In the oil market, the consolidation is still ongoing. We have been observing this for the last couple of Wednesdays, and we didn't see actually any move lower from this range, which stretches from 97 to 125. As you can see on the higher time frames, we do see the same consolidation previously from 2012 and 2014. So back and forth, we are still in the consolidation zone. More time we spend in consolidation, more time we might break in the direction of a trend, in this case, which is, of course, very visibly on the upside. 97 to 95, this is the Brent crude oil. Break will indicate a deeper pullback, but for now, we are seeing what we have been looking from the beginning of this move. Possibly a triangle formation, still not yet over, obviously, but as I said, as long as we consolidate, the risk is on the upside with some targets above 136, 140. And as you can see, I'm looking this cycle of oil move on the upside. This is the chart going 150. I think I didn't calculate exactly what it's go from 1962. So it's almost 160 years. And I do see this as a fifth wave going further upside, but my targets are pretty hard to imagine now. They're stretching from 202 to 232 in the next couple of years, because before this cycle finishes and oil starts to move lower. So I'm looking for the wave 3 on the upside, pullback in a wave 4, which might last half a year or a couple of years, and then further continuation on the upside towards this target, which is, as you can see, a pretty bullish development on the chart. If we look at the net gas, you know that we have been bullish for the target around 10.22. Net gas is continuing in a 5-wave manner in this intermediary wave 3. So it's a primary wave 3, but intermediary wave 5. We are moving into the consolidation zone, either a triangle or some type of complex correction, but still we are going higher towards this clustering that we see around 10.22. From there, I will expect a 4th wave pullback, which also agrees with what we see in rates, what we see in commodities charts, and what we also see in the Thomson Reuters CRB index. Oil is a tricky thing here because, as you can see, we lost inverse correlation between the dollar and the commodities. Everything is going up. We will have to look what will happen in the oil markets with this consolidation, but I can imagine a situation that oil stays in this consolidation and the net gas do some type of triangulation, which means a sideways movement before we continue up when this consolidation is done. So I think we are very close to reversal in these commodities, and that rates after the Fed meeting will be a pause on the upside. I think Fed will probably agree to make some type of a pause. Maybe they can sneak in 0.25 basis points once more, but I don't think they have also in their overall thinking a scenario where they want really to break the market totally. So if we look the next charts, which will switch us to metals, gold and silver, pretty, I will say, as I said it before, gold so weak, 88.8% retracement, although on daily RSI is lower, but the timing for the reversal from 786 zone, which we highlighted, is slowly passing. We need to see a sharp reversal up towards 2000 levels to stay actually bullish. You know our scenario that we even from these highs where this move was really pathetic in a beginning of the war between the Russia and Ukraine, actually fell from testing these lows. We do consider this some type of complex or flat. And for now, if we break this support level, which is pretty strong, we might spend some time there. I think we will continue lower towards this 1660, which will be a support zone for the further continuation on the upside. So we do still think that this is a fourth wave consolidation. Yes, there. Oh, I was thinking you're asking me something. Okay. So let's look silver. Same thing. We are jumping, not jumping, but just kind of consolidating from this 400 and something days support level, which is a natural 200 moving averages here. We didn't see a 5 waves up. We warned about this possibility that this is an X-way. It was a false break on the upside. People starts to be bullish, but then we collapse towards very rapidly, as you can see. So I don't think this move down is still over. We might consolidate a little bit before we continue to trade in the zone from 18 to 20, which I think it's going to provide a base before we start to move higher. So let's see what will happen there. On the crypto front, I think everybody, every planet, every person which lives on this planet knows about I think events in Terra Luna that has shaped crypto markets significantly. Bitcoin is hovering somewhere in between our 30 and 22K support. If you want to see more on cryptos, join me tomorrow for the Crypto Lab with Alex every Thursday, and you can also see our track record. I posted the last couple of years on my Twitter page. If you're interested how actually the Bitcoin was developing on the upside and downside from 2017. And we will show that tomorrow. So join me if you are available for the tomorrow stream. So that's all, Bennett, from me.
Very good. Much appreciated, Alex, as always. Just checking through the questions here. Yeah, looking at Bitcoin, he will be back, as mentioned, tomorrow, 9 a.m. right here on the Trading Analysis YouTube channel for Crypto Lab. Regarding gold, Alex, it does look as if that move up to 2078 could have very well been a corrective rally, and we are now looking lower in that flat. So, Terry, Alex, excellent work, gentlemen. Appreciate it as always. Members, we'll see you in about 17 minutes for our weekly member webinar. Viewers, will be back same time, same place next week. If you did enjoy the content, please subscribe with notifications. Give it a thumbs up. Lets the YouTube algorithm know to distribute it accordingly. Any final words of wisdom, Terry, Alex?
Thanks, and enjoy the rest of the week, guys.
Absolutely.
Yeah.
Appreciate it.
Trade carefully, of course.
Yes.
I'm all.
It's a challenging market. It's a challenging market.
Yeah.
All right, very good. We'll see you guys back same time, same place next week. Happy trading.